This is Macro Horizons, episode 325, Raising the Rates, presented by BMO Capital Markets. I'm your host, Ian Lyngen, here with Ben Jeffery to bring you our thoughts from the trading desk for the upcoming week of May 27th. And with the House spending bill reinforcing the worries about an ever-growing deficit, we can easily envision Besant flipping through his Rolodex. Taylor, Thomas, Travolta, Trump. There it is. Truss. Each week, we offer an updated view on the U.S. rates market and a bad joke or two. But more importantly, the show is centered on responding directly to questions submitted by listeners and clients. We also end each show with our musings on the week ahead. Please feel free to reach out on Bloomberg or email me at ian.lyngen@bmo.com with questions for future episodes. We value your input and hope to keep the show as interactive as possible. So that being said, let's get started. In the week just past, there was very little economic data of any relevance, and instead, the Treasury market was focused on deficit spending. This was reinforced by the House bill being passed and the trillions of dollars worth of additional deficit spending over the course of the next several years that will eventually need to be financed in the U.S. Treasury market. Even as the Treasury Department has retained the language that auction sizes will be kept stable for several quarters, the perception is that eventually coupon auction sizes will need to increase, and presumably that will occur in February 2026. If not, then it will be on the agenda for May of next year. In the interim, however, with auction sizes stable, the bulk of the additional borrowing will be done in the bill market. This isn't atypical, and the perception remains that there's ample capacity for the Treasury Department to increase bills as a share of debt outstanding to the high 20, low 30% range. Now, obviously, the final numbers are going to be a function of tax receipts as well as the administration's spending objectives. All that being said, the bond bearish implications from the budget played out in the longer end of the curve, not in the front end where issuance will be more relevant. For context, 2-year yields retained their anchor to the 4% level, while further out the curve, we saw the long bond trade above 5.1%. Now, this is the highest that the 30-year yield has been since October 2023. Recall in the second half of 2023, Treasury issuance was extremely topical, while Yellen was actively increasing the size of coupon auctions. And of particular note were the 10, 20, and 30-year sizes. It's worth highlighting that during that episode, Yellen eventually ended up not increasing auction sizes by as much as initially anticipated. This represented a departure from the more traditional behavior of the Treasury Department, which would have been to follow through and discount the increase in term premium. Now, with Besant as a new Treasury Secretary, it's not a foregone conclusion that the Treasury Department will behave in the same manner. However, we're operating under the assumption that the combination of the institutional knowledge at the Treasury Department, Besant, and any influence from Trump will leave the Treasury Department more active than it might have otherwise been, and by this we simply mean more responsive to market fluctuations, especially in the event of an extension even higher in longer-dated Treasury yields. And it will be interesting to see how, if at all, Besant chooses to address this issue. There was a reasonable amount of focus put on the 20-year auction performance on Wednesday. The auction represented 16 billion 20 years, and it tailed 1.1 basis points. The results subsequently triggered a more dramatic sell-off in the Treasury market than we'll argue was warranted. After all, refunding 20s, on average, tail 1.0 basis points. And while dealers took down more than the average, they only took down 16.9% compared to the norm of 15.1%. In short, we are viewing the post-auction sell-off as a market that was looking for an excuse to sell treasuries as opposed to actually taking direction from the results themselves.
While there wasn't a lot of top-tier, or frankly any top-tier data over this past week, that doesn't mean that the evolution of the macro narrative that has been nothing, if not exciting thus far in 2025, has not continued. The reshaping of the global trade landscape, tariffs, trade deals, the role that the dollar plays in the financial system are all the bigger themes that continue to be debated as investors continue to consider the trajectory of the global economy and the recessionary angst that has been playing a large part in the price action in treasuries that we've seen over the past few weeks. And the diversification narrative, whether that's from a reserve management or asset allocation perspective, is still highly relevant as investors around the world consider what role U.S. assets should play in portfolios. Now, in the wake of Liberation Day, there was the argument to be made that the U.S. pulling back from the global trade stage meant that 10-year yields were bound for 6% in short order, but instead what we've seen is that it's less about a complete step back from dollar assets or investing in the U.S. and more a reconsideration of a fine-tuning of allocations, maybe a little Europe, maybe a little Japan, maybe a little gold, maybe not a little Bitcoin, but it's at least part of the conversation.
I think it's also worth highlighting that the dollar as reserve currency goes beyond the simple trading flows. The fact of the matter is that so many financial transactions that are not directly trade flow related are occurring globally in dollar terms. So that in and of itself drives demand for the dollar that's not specific to any trade balance or imbalance. Said differently, wholesale de-dollarization would be very difficult to achieve, especially given the lack of a viable alternative, certainly not in terms of the depth and breadth of U.S. markets. So while we remain cognizant that this is a conversation occurring in the market, we ultimately expect that it won't define the macro outlook and instead simply be a background consideration.
And on the point of the role that the dollar plays not just in financial markets, but in the running of the global economy more broadly, there's no question that, as it stands, given the U.S.'s role as the consumer of basically all things from around the world, that's going to inherently necessitate firms, whether it's consumer discretionary, industrial, medical, be able to be paid in dollars and then deploy those dollars in a way that optimizes the running of their businesses. This dynamic also applies to investment, not just from a financial perspective, but also an infrastructure one in places around the world that are financed by debt issuance that in many cases are still issued in dollars. More generation of dollars that are utilized around the world for the actual operation of businesses, not just trading treasuries, is a system that has been established and entrenched over the last 70 or so years and is not one that's going to be quickly changed. However, and while this conversation is not relevant to the next 5 or 10 basis points in 10-year yields, a key theme that we continue to consider in evaluating the path of the global economy over the next several years, the next decade, is whether we start to see issuance on the corporate side occurring more frequently in other currencies. So a firm opting to issue in euros as opposed to dollars to capture the marginal increase in demand for European securities. Now, in that statement, the word marginal should probably be emphasized, given the magnitude of the difference in size of those markets and the fact that there really is no alternative for the dollar purely from a liquidity perspective, but it's an important, slower burning factor to consider. The same logic applies to a growing middle class with more discretionary spending potential in places like China, in places like India, and other developing markets where consumers are earning more money in local currency and spending that currency, thus putting non-dollars into the global economy that will be seeking a place to be invested. Is this going to drive payrolls and CPI next month? Absolutely not, but it's something that needs to be considered as we evaluate how the economy has evolved since the pandemic, through the Biden administration, and now as the Trump administration's influence is increasingly reshaping the stage of the international political economy.
There's another aspect related to the movement in the dollar that is worth noting, and that is that arguably the dollar was artificially strong coming out of the pandemic, and since Trump retook the White House, there has been steady downward pressure on the dollar. For nations who more actively manage their currency, the process of avoiding a sharp appreciation versus a dollar, or at least slowing the appreciation for the dollar, translates into effectively printing money and buying dollars. As a result, dollar reserves subsequently increase, putting more dollars into the global economy to once again be reinvested in U.S. assets, and presumably that will flow through into the Treasury market, given the breadth and the depth of the Treasury market.
And despite the consternation around the debt ceiling and the ritual that the market as a whole gets to go through around debating the X date, what if there's a late bill payment, why is there a kink in the bill curve, the reality is that as the benchmark of the financial system, treasuries remain the risk-free rate. And even after the impressive decline in yields we've seen since the peaks reached following COVID, that means that a return at 4% or higher, or a real return around 2% over the next 10 years that's backed by the full faith and credit of the U.S. government, is still going to be a structurally appealing investment decision, even if there's also a case to be made for owning boons or oats in addition to those treasuries. At the core of this line of thinking is how our star and the actual structural level of interest rates may have changed or not changed since the pandemic. While we're in the camp that our star hasn't shifted materially higher since COVID, there's no question that the realities of how the global economy changed since 2020 have only been exacerbated by the trade war. So before, if our star was close to zero, maybe now it's closer to 25 or 50 basis points. But it's certainly not 200 basis points. And it's that degree of shift that continues to inform our longer running, not weeks or months long, but years long, longer running constructive take on treasuries as the economic cycle plays out.
And this is all occurring in a backdrop in which term premium is well into positive territory. The reality is that investors are getting compensated to go further out the curve. Now, we do expect that term premium will increase further as the Fed resumes the normalization process. However, that won't necessarily translate into higher nominal rates. Instead, we'll argue that that will simply put a floor on how far yields can decline. Once we get further into the cycle, we start to see some moderation in forward inflation expectations. Break-evens then subsequently compress and nominal rates slip lower. This does make a good argument for sticky real yields, however, and as we look at the 10-year sector, anytime real rates move above 2%, we expect that there'll be solid buying interest, if for no other reason than a combination of the R-star narrative and the fact that the Fed will eventually get us back to neutral and, frankly, below.
And even after everything that's played out in the realized data over the recent weeks, it's the idea that monetary policy is still restrictive and the next move from the Fed is still going to be a cut. That means that even if it's going to be just 1 or 2 cuts this year, we are almost by definition going to have more than that priced into the futures market. The insurance premium that's built around the Fed being willing and able to quickly bring rates back below neutral and to quickly reintroduce a stimulative impulse from a monetary policy perspective to offset any economic shock is going to mean that we have to assign some probability that the Fed doesn't cut 25 basis points 2 times, but needs to cut 200 basis points 1 time. And especially with the memory of April's market volatility fresh in the mind of many investors, remember it's not just inflation in the labor market that the Fed is tasked with keeping an eye on, but it's also the shadow third mandate, which is the integrity of the market and the financial system, that could justify an emergency Fed response. Now, the volatility we saw in early April didn't quite get to that level, but remember, we did hear comments from a few Fed speakers that if things got bad enough, the Fed wouldn't hesitate to act, whether that be via buying bonds or lowering rates, but that's just another factor and another risk, especially in the current paradigm that advocates for a bit more cut premium than quote-unquote should be the case given what we've seen in the economic data.
So Ben, effectively what you're saying is data if you do, data if you don't.
We all data in the end anyway.
Data. In the holiday-shortened week ahead, the Treasury market will have plenty of incoming fundamental information from which to determine a trading direction. In addition, we have 69 billion 2-years auctioned on Tuesday afternoon, followed by 70 billion 5-years on Wednesday, and then an additional 44 billion 7-years on Thursday. As a theme, we expect that the auctions will go reasonably well, if for no other reason than demand in the front end of the curve remains solid. It's really duration that has been underperforming in the recent sell-off. Investors will also see the core PCE figures for April. Here we're anticipating a monthly increase of 0.1%. This would be a print that's very consistent with the Fed's 2% inflation objective. However, there remains a potential for the trade war to trigger a fresh round of inflation over the summer, and so it's forward inflation expectations that continue to drive the market's broader macro narrative. Investors will also see the revision to first quarter's real GDP, and while the slightly negative growth figures were easily dismissed as a function of the drag from net exports, the market will be watching closely for any downward revision to the previously reported strength in the final sales to domestic purchasers category. We also have the release of the FOMC minutes on Wednesday afternoon. Here, we don't have any great expectations for the Fed to provide insight beyond what the FOMC statement laid out and Powell communicated at the press conference. The key for the Fed at the moment is that monetary policymakers remain in a wait-and-see mode, and given all the uncertainties triggered by the trade war and the subsequent price action, the Fed is clearly in no hurry to restart the process of normalization. And it's certainly not wasted on us that the recent backup in rates should create or at least reinforce the downward pressure on risk assets, which is, in effect, the market tightening for the Fed at a moment where the Fed is worried about the reacceleration of inflation. Now, while we maintain that the Fed's most likely response function to elevated inflation over the summer months will simply be to delay rate cuts further, monetary policymakers surely take at least some solace in the tightening of financial conditions created by the recent sell-off. We've reached the point in this week's episode where we'd like to offer our sincere thanks and condolences to anyone who has managed to make it this far. And as we prepare for the long holiday weekend, we're reminded that a bad day in the country beats a great day at the home office every time. Working from home is still working. Kinda. Thanks again, SIFMA. Thanks for listening to Macro Horizons. Please visit us at bmocm.com/Macro Horizons. As we aspire to keep our strategy effort as interactive as possible, we'd love to hear what you thought of today's episode. So please email me directly with any feedback at ian.lyngen@bmo.com. You can listen to this show and subscribe on Apple Podcasts or your favorite podcast provider. This show and resources are supported by our team here at BMO, including the FIC Macro Strategy Group and BMO's marketing team. This show has been produced and edited by Puddle Creative.
The views expressed here are those of the participants and not those of BMO Capital Markets, its affiliates, or subsidiaries. For full legal disclosure, visit bmocm.com/macrohorizons/legal.